there will be no clawback, right? What that means is if you use an exemption in the period of time when the exemption is high, like now, or the next year or two, and then you have the exemption drops down to say 7, but you used 12 of your exemption, you're not going to be penalized for that extra 5. What's going to happen is that the gifts or the use that you've made in that time is going to essentially, as the exemption goes back up and goes back up, we're going to keep track of it. You just can't make any more non-taxable gifts. If you do, they'll be subject to tax. They'll be subject to gift tax until the point where you've recouped it and now you have positive available exemption. Okay, so it's not lost, that piece. You're not going to get clawed back. However, if you haven't used it and then it drops back, it's currently now almost $13 million, and then it drops back down to say 7, that extra excess over 7 is gone. You didn't get to use it, so you lost it. Okay. Now let's do another history of New York estate tax, right? I went back to 2000, and this is when it was at $1 million per person. The maximum rate has been pretty steady at 16%, right? And you'll see over time that the exemption started to bump up a little bit, bump up a little more, to the point where and this is also, you'll notice at that period of time, New York has a fiscal year that ends March 31st. That's why the budget start and the calendar year was starting April 1st in these tax years until the end of 2018 when they finally put it to a calendar year. But each of these exemptions went up. So it started to track and then became closer and more relevant to the federal, but then it decoupled, right? And then the federal exemption just skyrocketed and New York stayed where it was in this range. So up until today, where it's currently at $6,580,000 per person, right? Okay. So we want to avoid falling off the cliff, right? That's what they call it. When you have 105% plus $1, you've essentially fallen off the cliff. It's phased out. There's no more exemption, and you're taxed from the first dollar. What can you do to avoid this? Well, you can use things like irrevocable life insurance trusts, which we'll talk about. You can include something called the Santa Clause. Sounds really fun, right? But essentially, it's a provision in a will where you can add a charitable provision where it says that if there's something that is going to cause an estate tax, I want to make a charitable deduction up to the point to bring my estate to where it's not taxable any longer, and then I won't have estate tax, right? Gives you some flexibility. Other things you can do to avoid falling off the cliff is to use a credit shelter trust, which we'll talk a little bit more about soon. You can always move out of New York, but we don't want you to do that. We want to keep our clients here. And then sometimes you can change the type of property to be non-New York tangible property using things like maybe limited liability companies, which is a little outside the scope of today, but it's something you can do.